Good morning, Peter.
Can you hear me?
Can hear you, buddy. Thank you so
Okay,
much.
good.
Thank you so much for stepping up.
Thanks for having me on.
Your brother, you know, coming in, and I know you have a busy schedule, and you're one of my favorite guests, Pete. So thank you so much for being here. You know,
yeah, thanks for having me.
You're a very talented cartoonist too. If you could see my screen, Peter.
Yeah, unfortunately, I didn't draw that.
What a surprise. So, yeah, normally I'm asking you what I want to know from you or what I think the viewers want to know. I'd like to start it off differently. And, you know, I'm guessing you're really focused on this inflation article that's pretty recent for you. It's, in fact, today. So tell me what's on your radar, buddy.
Well, for months, I've been pounding the table that inflation pressures are building in a lot of different places. Whether now it's being shown up statistically, but anecdotally, all you had to do is read through for months a lot of the market PMIs, not only in the U.S. but in Asia, and particularly in Japan, believe it or not, and certainly in Europe, driven by tighter supply chains, rising wages, higher commodity prices, and now it's beginning to show up in the data, particularly in the PPI side. I also want to add trucking. Anybody who has to deliver a good on a truck will tell you about the double-digit inflation that they're paying to have a delivery, whether it's because there's a shortage of truck drivers or because of this new law that came into being that limits the number of hours that truckers can drive. So that will, in my opinion, over the next few months, start to filter into higher goods inflation. The reason why that's important is because over the last couple of years, we've seen services inflation running at about 2.5% to 3% in a very sticky fashion, driven by higher rents and medical care, and goods deflation. So now if you combine an uptick in goods inflation for the factors I just mentioned, along with sticky services inflation, it could combine with some upside surprises in the headline inflation numbers. So we saw PPI hotter than expected. CPI was about in line yesterday, but still above 2%. And today, core import prices, or we're just really actually looking at ex-petroleum, is now running above 2% at a multi-year high. So I think that should be taken note. I think it's one of the reasons why we continue to see a rise in short-term interest rates counterintuitively, because you'd think, okay, higher inflation would lead to this rise in long-term interest rates. But what I think the market is saying is that the sticky inflation numbers that are now trending higher will force the Fed to continue to hike rates. But the long end, while rates have risen, they're still contained relative to the short end, and we're seeing this flattening because people are worried about, okay, the Fed's going to keep on hiking. What does that mean for growth? It'll probably slow growth on top of tariff concerns and a U.S. economy that still can't get out of this two-handle type GDP growth.
Yeah, Peter, does this remind you of the 70s of stagflation, where you have low growth, but now inflation's starting to pick up? And a lot of the market chatter is that the Fed definitely will go in June, but a lot of people are saying after June, maybe one more in December. Do you think they're going to have to be more aggressive than that? And, you know, I think, I don't know your age, but I think you're around in the 70s. Is this deja vu in some way?
Well, in the 70s, certainly, the scale was much greater in terms of the inflation numbers. So I would consider this maybe stagflationary light potentially.
Okay.
But it's the absolute level is less important than the direction, where inflation ticks up and growth still remains pretty mediocre. I do think the Fed wants to front load the next two hikes in June and September, and then leave themselves open to a possible December one, just depending on how things go. So the Fed has no idea whether they're going 2 or 3 more times because it's only April. But I do know they in their minds, I do think they'll go in June. I think they want to go in September to get the 3 out of the way, to give them the flexibility of whether to do it or not in December. And of course, where the S&P 500 is, where the data is, will depend on whether they squeeze in another one. Now, in the minutes yesterday, they did hint at wanting to go 4 times by talking about a potentially steeper than previously expected path of rate hikes. But, you know, putting aside the rate hike discussion, they're still shrinking their balance sheet, which is now accelerating on a quarter-to-quarter basis, and it's going to total $90 billion in Q2. So it's not just the rate hike that is a form of tightening. It's the balance sheet that is another form of tightening. So I think we need to look at those two things together.
Let me ask you this, with the quantitative tightening that you've been talking about, and one of the worries of the market over the last month or so has been the LIBOR rate. And banks, I read explanations of banks being unwilling to lend to each other, which was pressuring the LIBOR rate. Can you address that and what you think is going on with LIBOR?
Well, certainly some of it is technical in that there's a lot of supply in the short end. It also related to repatriation, where there's a lot of corporate cash that's coming out of, let's just call it the commercial paper market, and is being spent on stock buybacks or higher dividends. So that leads to less liquidity in short-term funding. And then, of course, it's the Fed raising interest rates. I think all combining for the rise in LIBOR. But whatever the reason is, it's basically doubled over the past year, and it's leading to a higher cost of capital for all those LIBOR plus type borrowers, which total in the trillions.
Okay, so but last time we talked, this was not on the front burner, but now it has. I think the Fed even mentioned it in their minutes, and that's the potential for a trade war. A lot of people are saying it's just posturing. And some of the market evidence is that if the market believed the trade war was real and happening, instead of low volatility in the FX market, we'd have much higher volatility in the FX market. How is this fitting into your trading investment thesis, this potential problem? And do you think that we are going that way, or both China and Trump will pull back?
I do want to believe that both sides can't be so stupid to really push this. I mean, I understand the issues that we have with them in terms of IP and the level of tariffs that we impose relative to the ones that they impose. So I get all that whole argument. It's just a matter of how you go about this. We're already changing behavior in response to the potential tariffs. You already have companies that need steel supply that are front-loading purchases. You already have, so there's stockpiling going on in anticipation of this, even if there ends up not being any tariffs. So I do think a lot of this will get dialed back. I do think that there'll be a picture taken moment to say, okay, we came to an agreement, even though maybe there's not much substance behind it, because I think that there's enough cooler heads that will prevail. That said, I'm not encouraged when I listen to Wilbur Ross and Peter Navarro defend their stance on this. So while I understand the end they're trying to achieve, I'm not a fan of the means at which they go about it. I mean, if you're a soybean farmer in Iowa, I'm sure you're having a lot of sleepless nights, and you're not feeling better when you hear, oh, you're taking one for the team here.
Right, yeah, and that spreads across the whole agricultural sector, including hog farmers, as Chinese import a lot of pork from these guys.
Yeah,
so.
And the U.S. farmers had a rough 6 years. I mean, prices peaked out in 2012, and it's been a tough slog ever since. This is the last thing that they need.
Yeah, it's kind of hard for me to, swallow that, having been in commodities for a long time when I can remember $2 corn and $4 wheat and $5 beans. So, yeah, from the peak, they've come down.
But
you know what I mean?
The cost of their inputs has gone up a lot too. The cost of running their tractors and oil, exactly. So their profit margins aren't that much different.
Yeah.
Right, exactly, for all of us.
Okay, so let me ask you this, Peter. I know that you've been kind of skeptical of U.S. strength, equity strength, and they've taken some of the air out of the fangs. But I know you've see value in emerging markets. Does that investment thesis continue for you?
It does, but you really have to extend your time horizon. I still believe that is where better values are and where growth will shine over the next 5 to 10 years. But in the short term, emerging markets are certainly not going to be immune from trade spats and potentially slower growth. But I still would rather be more weighted to those markets and think that they have a higher chance of outperforming U.S. markets over the next 5 years, particularly Asia.
Okay, do you make anything out of the quiet trading range nature of the US dollar and the euro moving sideways for quite some time in a fairly tight range? Does
Well,
your bullish bias continue in euro
well,
and
no,
dollar?
yes, it does actually. So you had this around a 10% decline in the dollar in 2017, and no bounce whatsoever in 2018, with the Fed continuing to raise rates and even talk about raising a fourth time this year, and persisting with the balance sheet reduction. The dollar can't get out of its own way. I mean, that is a glaring sign of any tape watcher that the dollar is likely headed lower after this consolidation ends.
Okay, and we saw the precious metals kick to life, Peter. Still such a dramatic lag in the miners compared to the bullion. Still constructive there?
Still very constructive. I think compelling space to be in. You know, there aren't many asset classes in the world that you can buy for such dramatic levels off the peaks of years ago. I mean, I was looking at a chart in silver yesterday. Silver looks particularly compelling. I don't really see much downside. So I'm very bullish on that space. And everything that I see each day gets me more bullish in terms of geopolitics, tariffs, politics, and the action in the dollar, and also in the behavior of real interest rates.
And how about the behavior of the oil market? You know, there's still a lot of oil bears out there that aren't believing this. I've heard that fundamentals have shifted pretty dramatically, and then you throw in the geo risk. Even though Syria's not an oil producer, they are lobbing missiles towards Saudi Arabia infrastructure. Are you playing this oil trend from the long side? Because up until maybe a week or so ago, Peter, even though oil has been performing, the shares really underperformed against oil. You're looking for a catch up and like that sector?
Yeah, I'm still long some oil for clients. I think the other geo situation is what happens with Iran and whether we slap sanctions on them again, since Iran obviously is a pretty big producer, and the global glut continues to shrink. I mean, we're about to, I think it was the International Energy Agency the other day that talked about global inventories actually getting back to its 5-year average again. So I think if anything, oil is going to continue to surprise on the upside, as are some other commodities. Now, look what aluminum's done this week with the Russian sanctions. It's up almost 10% this week.
Right.
So I think that there's still potential upside pressure. Now, granted, the offset is worries about growth and what that means for industrial metal demand. It is the tug of war, exactly. And even in agriculture, which I believe is beginning a bull market, you have a day where you get worried about soybeans. But I think overall, I still remain pretty constructive, not just in oil, but agriculture prices as well.
How do you participate in the ags? You use futures or some type of ETF based upon the
yeah, you use ETFs that capture the futures, but also individual companies that happen to be in those spaces.
Okay. And would you say that the arrival of John Bolton kind of gives us a little bit of a clue as to whether or not the Iran nuclear deal is going to be decertified?
It's a good question. I'm not really sure. I mean, I know Bolton talks a tough game, but there's so many people surrounding him that sort of reins in people that talk tough on TV. So I'm not really sure exactly where that goes, but just the prospect of it, keeps a bit under the price of oil.
I really don't like to talk about this because, their emotions run so high with what's happening here in the U.S. Politically. But do you think that the markets are going to react dramatically if President Trump tries to make a move to shut down this investigation by initially firing the Deputy Attorney General?
I mean, I think optically, it's obviously a big deal. It'll be some interesting drama, but I think in terms of the markets and the economy, They're more focused on interest rates. And I think from a policy standpoint, the markets got what they wanted out of Trump already, and that was the cut in the corporate tax rate. And that was an easing of regulations. So regardless of what happens to Trump over the next couple of years, I don't think the markets at the end of the day really care, again, because they got what they wanted out of him already.
Okay. You know, I interviewed a guy, I don't know if you know him, Kip Harridge, and he thinks that the market is way underestimating the power of the tax cut package that we just got, using the analogy that it took about a year and a half, 2 years for Reagan's tax cuts to really impact the economy. Where do you stand on that? I said, could they have been more front-end loaded and they're already having their impact, or do you think that we're going to get some benefit market-wise from them down the road?
Well, a couple of things. First of all, cutting the corporate tax rate is not a stimulus package. It's a long-term objective to make the U.S. economy a more competitive place to do business. So this takes years for us to really reap the benefits. On a pure dollar basis, unfortunately, a lot of the benefits of the corporate tax cut are being offset by higher interest expense and higher wages. So on a dollar-for-dollar basis, there's really not much of an incremental gain, because we talked about LIBOR, where that higher interest expense is eating into the benefit of a cut in the corporate tax rate. And you look at wages. So overall wages in this country are about $7 trillion. You add a 1% gain in wages, that's $70 billion. Well, the tax cut's only a little more than $100 billion. So we can't look at the tax cut as an all else equal type scenario. So I'm more skeptical about the short-term stimulative nature of it, but I'm bullish on the long-term ability of it to make the U.S. a more attractive place to do business.
Okay, interesting, Peter. So I want to encourage people to go to your website, the Book Report, and to follow you on Twitter at Boockvar. Anything else?
And anybody interested with help with their portfolios, I'm also the Chief Investment Officer for Bleakley Advisory Group, and they can go to bleakley.com to learn more about us.
Okay, so a lot to pay attention to on Peter's website. Thanks so much, Peter, for coming here today, my trading warrior brother. Always appreciate your insights. Where's the 10-year going to be at year end? Give me a Nostra Boockvar.
I still think we're headed above 3%.
Okay, bro. I appreciate it, Peter. Good hunting. And
thanks so much.
Thank you very much for being with us today in F.A.C.E.
Great.
Thank you, everyone from investing.com, for spending your morning with us or your evening with us. And we'll see everyone tomorrow. Good hunting. And most of all, remember, don't just count your pips, count your blessings. I consider it a blessing to work with this team and be able to talk to people like Peter. And our mission is to build up and edify traders every day. I hope we accomplish that today as well. See everyone tomorrow. Adios. Good hunting.